So let's grab a beverage and get in here. Is this not yet? That's on. All right. Yeah. So that makes me sound official. Although I must say, when I was a kid, I was always the kid whose voice the teacher could hear above others, so I always got pounded for talking in class. So I really don't need a microphone.
Is that why you're a man of few words?
Yeah, I'm a man of few words. So let's get settled here. So it is a little later. We had a little just organizational snafus, but when you run events like this, one gets used to that. And so I want to thank you all for showing up. For those of you who haven't been to a NYPAY event before, I do hope you enjoy it. Many are familiar faces. The whole idea behind NYPAY is that we figured there's a lot going on in this whole, started off as payments, transactions, and it's kind of morphed into fintech. A big portion of it is overlap. And it's good to have those discussions that the big conferences you might have in the hallway when you meet up a bunch of people. But put those together after work. Doesn't take up a lot of time. You stop by, have something to drink, have a good chat, and you talk about an interesting topic. So, welcome. If you haven't been here before, questions are not only welcome, but they are invited. The best of our events are those where the audience is really engaged in asking questions and discussing. So, with that, I will kind of kick this thing off. My name is David True, and I'm the president of NYPAY. We've been at this for about 8 years now. The way this started was, first there's Edwina Johnson, very happy to have, Eric Soto, and David Sika. And Edwina is with a startup called Alloy, which has been around how many years?
I think maybe 4 or 5 years.
4 or 5 years?
Yeah.
Eric, how long has Socure?
Since 2015.
2015. And David, how long? Well, David is, I'll give him a special intro. David was a very integral part of NYPAY a while ago, and then he went and joined with a gentleman named Hans Morris, who was running Visa when Visa went public. And David was integral, I think, in helping Visa go public, right? You ran the numbers?
Joined shortly after.
Sort of. And now he is part of a venture capital firm called NYPAY Partners, New York, California Partners. And a while ago, I was talking to David, and we talked about events and topics we could cover. And he said, well, why don't we do one about Fintech 1 versus Fintech 2? Because things have changed so much. I mean, when Fintech first started, after the financial crisis, there was, it was a different situation between what Fintech is today. And we thought that was a good idea and threw it around. And I might just pitch this over initially, since David was the genesis of this idea, and let him talk about what he was thinking.
Yeah. Well, thank you, and thanks everyone for coming. When we first started the firm, it was in 2013. We had the initial idea, and the observation in the market was you had at that time hundreds of entrepreneurs that were entering financial services and saying, the same way you would, like many Silicon Valley firms would approach your problem in saying, hey, it's been 2 or 3 decades since these.
Why are we feeding back? Let me turn this off. We'll turn it on.
I'll try to do it without. Can you hear me okay? So the initial idea, or initial observation in the market was that you had hundreds of entrepreneurs that were entering financial services. And I'm sure you've all heard the pitch, right? It's go after, it kind of holds true with every part of financial services, but there's many people and brokers involved. So they're adding all this extra cost to the product. The product's opaque, and in many cases trick somebody into a profitable relationship. And
Trick? Okay.
Trick, late fees, this sort of thing. And the third is the execution of it was slow and sloppy. Right? You're dealing with people, spreadsheets, paper, and it's like, if I open my iPhone and everything on it, like no financial services company that's just creating a digital process from the paper process is going to win that real estate. This is kind of an initial observation. And what we were noticing is that all these companies were getting a lot of funding. So the traditional venture capital firms were investing in startups and saying, wow, that's a really, with the traditional formula that VCs would evaluate a company. This is the best team focused on a big market. They found product market fit. Great. The difference in fintech is that, fintech's this catch-all word for today 30 massive industries, right? And each of those industries is very different. I mean, it's not fintech, this is financial services going forward, right? Like in my view, is like, hey, listen, if people are gonna, if talent's gonna be attracted to fintech and capital is gonna flow to it, that's great, call it what you want. But, over time, it's gonna be a payments business, a lending business, an insurance business.
So fintech will disaggregate into those different verticals that it comprises.
Yeah, because they're all so different, right? If I'm a fintech investor and I don't understand insurance, I'm not a good insurtech investor. And I think the competencies are really being built here. In 2000, so post financial crisis, I think some of the earliest fintechs recognized that following the crisis, banks really needed to cut back on their innovation factories.
Did banks have significant innovation factories before 2008?
Well, I mean, I think they did, right? Companies were building products, whether or not.
Why is that? Can you guys hear us without the mics?
No, bring the mic closer.
It's better
You
with
think
the
closer?
Closer. Yeah, closer, then it won't happen.
Okay,
Oh,
thank
he's
you.
a sound expert too.
It's good we have a technical expert here.
I was a guess, it worked.
Well, I would say there are ideas, right? Like definitely banks and payment networks and so, but whether or not you like arguing the merits on whether banks were good at building products, I think kind of went out of the window post crisis, and that they just didn't have the money to invest in, research and development and pumping money into innovation because they had to be compliant with, the new regulatory, world they were going to live in. And some of the early companies, so like Wealthfront, Betterment popped up, and they came out and said, kind of the same thesis I was describing earlier, where let's go build a new brand. Let's go build a new brand around, that people will be happy banking with. And I think at that time, a lot of it was around millennials don't want to bank Chase. They want to bank a new brand. And they had one simple product, which was we'll be your wealth manager. And instead of paying a 3% wrap fee at Morgan Stanley, you'll pay 25 basis points and get, the same asset allocation. And you'll have the same results.
Which one was it? Betterment?
Betterment and Wealthfront. Wealthfront was in San Francisco. Betterment was in New York. And at that time, the banks were like, I remember you heard a lot about, is this a bank killer? You'd hear these sort of articles. And banks kind of laughed it off. They're like, that business is so hard. You need under management to make that work. And we've been doing this forever. And we don't think that's very interesting. And that kind of got to our conversation around, around how fintechs evolve. And I would say probably 2 or 3 years ago, banks went from no one's going to kill us to, okay, we surrender. We're not good at building products. We've tried a lot of times. Like when you hear the quotes on like what Visa spent on Visa checkout, it's like,
What was it? Well, you can't
I'm
say.
not kidding.
You can't say. It's a big number.
It's a big number. And it's something a startup can do for a lower price. And banks started coming around. They were open-minded. They were saying, you know what, we think there's some merit to what's going on in the fintech world. So instead of worrying about them taking share from us, we can compete. And I think there's this interesting dynamic going on in fintech where you have, I would say there's a dozen companies right now that are in the running to become the next Amex. And each one has led with a different wedge. So they have a different product, and they're all unique. But I think Coinbase competes with SoFi. And then over time, so the banks were watching this, and they were saying they were able to sit behind and watch 2 years earlier and say, wow, they found product market fit. Consumers really like that. And then they're turning to the fintech market and say, well, who can I partner with to offer that sort of solution? So in the case of robo-advisors, there's a company called SigFig, which is licensed to wirehouses where they can launch their own robo product. So that was kind of, I think that was kind of the idea for the event, and but just understanding kind of where we are in this evolution, how some of the companies are performing that are part of that first wave, and then what are some of the areas and opportunities that banks will be looking to and looking for partnerships with fintechs to,
So is this like Stripe and Square is the first wave, right?
well, payments really was much of the first wave. And I think Stripe and Square got the Valley excited. But it's a little different when you look across, fintech products.
So there's a bit of what David does in his thinking, and let's go to our other two panelists who have so graciously agreed to join us tonight. Eric Soto of Socure, tell us a bit about you and a bit. I know you're not at Socure a long time, so I don't want to.
Sure. So I'm the VP of product for Socure. Been there for 6 months. Literally hit my 6-month mark last week. I was trying to go through what I've accomplished. Trying to learn a highly complex product that we offer a platform, predictive analytics platform for identity verification that specializes around third-party fraud mitigation, which is a huge problem for anyone that needs to validate, whether it's at checkout, at the first time of seeing, account opening, whatever that is, anyone that needs to verify who they're interacting with, we provide a solution, whether you're validating all CIP, PII information, or just one-point solution email. We provide a score for it. In fact, we partner up with Alloy, who provides the workflow. I won't steal your thunder, but we partner up with a lot of channels and then go direct. Prior to Socure, I was at BBVA working on the open platform. So
I've heard of them.
Yeah.
building APIs. Yes, globally.
A couple years ago, we did an event with BBVA and their, I forgot what it's called again, the startup initiative.
Open innovation.
Yeah, that contest. Yeah, we did one. Anyway.
Yeah, so actually, to your point, you were mentioning like bank innovation. Obviously, that hasn't stopped. But what I've seen is like some banks have labs where they just throw a whole bunch of money at a lab with no specific purpose, just a bunch of smart people toying. And at BBVA, we actually had a very focused initiative where we bring EIRs, entrepreneurs and residents, go through an ideation session, find a market that we want to tackle, then they have to go to a funding committee, beg for some money, and then not throw a whole budget at it, but like slowly, once they hit milestones, they get funded, and then you incubate a whole bunch of businesses. And I've seen that work a lot better than just having open labs. Like I was at Capital One. I mean, they're doing great stuff, but like their labs initiative is pretty big, and a lot of the time some projects get lost. But anyways, prior to BVA, I was at Capital One, so been working in fintech for about 10 years now.
And I got to give you credit, half credit. You used one acronym. I usually say if you use an acronym without explaining it the first time, you get penalized. Now, you did it initially. I think PII, most people know, personal identifiable information. You used a different one. I forgot what that was.
API.
What?
API?
No, there's
CIP, Customer Identification Programs.
Okay,
I've been
good,
working fairly long in the automation of underwriting and identity, so it just comes
KYC very short.
Yeah.
better known as KYC.
Yeah, but you also
Yeah,
explained the last one about the innovation lab. You used some term for entrepreneur in residence or something.
EIRs,
So that was
yeah.
good.
So they're
touche on that. Just keep that in mind.
Thank you,
That
yes.
that all of us know most of us know transaction payments, but acronyms can lose one. Edwina,
Yes.
it's nice to see you here. So why don't you tell us a wee bit about what Alloy does?
Yeah. So as Eric mentioned, Alloy is also in the identity space. We provide a single API integration for banks and fintechs, and then we provide a decisioning workflow on top of all the wonderful third-party data sources, fraud scores, authentication devices that you might want to use within your onboarding decisioning process. So again, for KYC, for anti-money laundering, for fraud purposes. Yeah.
So how is it that you guys work together? What's the connection? What is it one provides that the other one? What's the complement?
So we'll be the kind of the decisioning engine bit and the rules which our bank or fintech customers are programming, and then Socure is an awesome data source and fraud source that plugs into that.
So you source some of the data that you provide to your customers from Socure.
Yes.
Okay.
Yeah.
So I actually got to know Alloy when I was still at Capital One, and what was really neat is they provide they have all these API integrations into backend data sources, so they really simplify it for the customer, right? And then they can come in as like, I want to use this, and this. We prepackaged some best practice logic for customers and for Alloy to deliver through their workflow mechanism. But it's really neat. Something that we don't touch. We don't orchestrate the calls. We just provide the data for decisioning.
Well, you're the orchestra.
Yes.
Okay, got it. With
Yeah.
a very, very nice delivery. So thinking back to what David was talking about earlier, just some of the changes that have gone on. Maybe I'll pitch it back to David since you've been watching it for a while. In the initial time, just post crises, what were some of the solutions that any of you can talk to this that you've seen that went in and filled gaps or holes that needed to be filled?
I mean, I think the three big ones were all payment companies. So Square, Stripe, and Braintree. Square made it easy for anybody, regardless of how small you were, to get a merchant account. Braintree said there's this new type of commerce that's emerging for which there's no good payment solution today, which was 2- and 3-sided marketplaces. And if you were Uber or Airbnb, you really couldn't go to authorize.net or CyberSource and get the solution you wanted. So they said, let's build a custom payment solution that could really.
So why couldn't you go to authorize.net? Just walk me through why that didn't work.
A lot of these things, I don't think, because if you look at what's happening in fintech, it's not necessarily, is it possible for authorize.net to process those payments? It's just every possible procedure they have is set up so that a startup can't use it, right? So, applying for a merchant account, having the ability to work with engineers on the other side, like while you're building it. I think technically it's probably not that big of a change, right? But it's different. And Braintree became a huge success because those companies did. And I think that's always been a lesson in payments, where when you offer something that's slightly better or even a lot better than what's existing today, it's not necessarily going to beat out what's in place because the switching cost is too high, right? So if I say, you have a dumb terminal, here's a smart terminal, that hasn't taken off the same way we thought it was because it takes a lot. Stripe came along and said, well, what Braintree did is interesting. I think they did a few different things where it was, we're going to market to engineers. So we're going to have engineers selling to engineers.
And who was Braintree marketing?
Braintree really had, they had a few core customers in the early days, and then Stripe came around and said, well, we can build a better API, and we can and locate ourselves smack dab in the middle of Silicon Valley, and have the best engineers that are pleasure to work with. And it just so happened they did that at the beginning of the startup, right? So everybody integrated Stripe, and then that's where we are today. And I think that really got the Valley excited about fintech generally. But I would say that was all, really payment ideas. Silicon Valley fintech companies that were successful, those three, I think, got everybody's attention.
When did Stripe hit the U.S.? I'm trying to remember when they started. I can't remember the year. How many years ago was it?
Yeah, that's 5 years ago.
A little earlier, I think earlier than 12.
So
it was probably, I would guess, 10. And then it took off because Braintree got acquired in 13.
Yeah.
Stripe started becoming popular in 11, 12.
I think Stripe really hit the public consciousness because they were also in 60 Minutes, and it's two good-looking, very young guys from
well,
Ireland.
it depends on who's conscious.
Yeah.
Clearly yours.
But they didn't look like they were 20 years old or something.
Yeah.
It's such an amazing story.
And it's
I have a question about Stripe. So Stripe is basically an ISO of Wells Fargo. I think if you look on the bottom of their website, it says an ISO of Wells Fargo. So yeah, they did the technology different, but they still had to onboard all these clients like you would in any other ISO. So what did they do that was different?
No, they don't, because they're a merchant. Sorry?
Independent sales organization.
Please.
They're actually a payment service provider, right? So
Yeah.
they're taking all the risk, and they've
Processing
regulated their own
work.
onboarding to
But at the
evaluate their
beginning,
risk.
weren't they
Yeah,
at the
yeah.
beginning
Yeah.
just an ISO of Wells?
Yeah.
It took them 2 years
Well-
to actually launch because they're like, this process is broken, merchant accounts are stupid. We should fix
So
that.
there were at least two things that happened in that case. There was the technology they built, the good API. Stop me if I'm going too far afield. But there was also rules changes on the part of the incumbents, Visa and MasterCard, to allow for this aggravator, this merchant, this payment facilitator model. And we actually had an event on payment facilitators in January, which was crazily popular. We had like 120 people.
That was awesome.
But payment facilitators allowed that because who
Stripe is uses Chase. So they're both things. You have to have a
Very
bank.
Stripe made it in
Yeah.
a way that was so easy for anybody to take payments if you could use their API, which was super easy. Anybody that can write an API or plug to an API, you can take payments immediately. So it made it so easy than grabbing your phone, calling Visa and applying for something and just plugging into their system.
And then they did things like plug it into Squarespace, so anyone who wanted some sort of
Exactly, yeah.
goofy website that they wanted to sell, whatever the heck they wanted to sell, it was like already embedded, so you didn't have to think about it.
You just have to think about the cost, which is like a 3% that you're paying them.
Well, one observation I've had, and we'll get to this in a minute with the other conversation, is that simplicity has a value for it that I believe was undervalued by many people, many incumbents in the industry. You know, payments guys would say, oh, they're paying 75 basis points more than they should, but it's really simple. And just knowing exactly, in the case of merchant acquirers, knowing exactly how much it was going to cost every month was much more valuable than someone saving you money from a statement you could never understand anyway, so you never knew what you were saving. So anyway, that's a point just about the value of simplicity.
There's a big distinction between initiating and capturing a payment and then all the shit that goes on behind the scenes to actually clear and settle that payment. I mean, there's lipstick on the pig models that will make capturing the payment right, but there's still this vast infrastructure behind, all the risks, the systemic risk, the clearing and settlement overheads, the fees, God knows what, and no one's fixing that.
Even
So it's
on
one thing to put
instant,
this thing on front, but everyone's ignoring
Faster payments.
and that's right. Even on like instant, like the OTC, like the Visa offers where you have instant payments, right? Instant settlement. The money hasn't moved. You still have to settle at the end of the day. So it's just like lipstick on top of
exactly, you've captured it, and you've actually created more complexity in the actual
Yes.
completion of that deal, more systemic risk and everything else. You've satisfied the cabinet front end, but you haven't fixed the back end.
And that's how you get the customers.
Well, that's right.
Yeah.
But yeah, okay.
And then you have the power.
I think we've been here before.
Just interested to hear about, I guess, the onboarding experience, right? So for consumers, you can do it pretty much instantaneously for automation. With businesses, you require, obviously, additional documentation. In our experience, the expectation from the business is they're acting as a consumer, right? So they expect to be onboarded within 24 hours, then we need X, Y, Z. You guys obviously in that field, in the trenches, is there innovations in that perspective of being able to automate as much as possible to get a business on board as you would as a consumer?
I'll take a stab at it. At Capital One, we were building a small business, the Spark brand for small businesses, right? And on the bank side versus the credit side, a completely automated, non-documentary mean to onboard small businesses. The operations piece of onboarding those small businesses was very troublesome. So we started about 10% auto approval rates, and after a lot of work, we were able to take it up to, just above 50% on the consumer. To give you an idea, you're talking 90%, 92%, right? That's our bread and butter. But I found that one of the challenges was, these sole proprietors, they were inputting their DBA names, and then the systems would try to recognize them as bigger businesses. You go into all your data sources, you're not going to find them. And it was a matter of swapping it around. Are you reporting taxes with your SSN, with your EIN, kind of narrowing it down? Do we underwrite you as a consumer or as a business? I've seen some companies take stabs at it. Some have shut down those businesses, but it's something that I can't speak much to it, but it's something that's near and dear to me, and there's a lot of room for opportunity. And like you said, the other piece is like small businesses do expect a little bit more friction, which is very unfortunate. Unlike consumers, they want it instantly. So then the question becomes: Do you automate the piece of collecting the documents and doing some OCR, or do you truly go for a non-documentary experience? I don't know. We'll find out.
So wait, your point was they expect friction, so if it goes.
Well, I mean, it's more like a consumer would expect. I go online, I sign up for a bank account. Like I'm not going to give you one piece of document. I'll give you some personal information.
Right.
But small businesses have that expectation that they're going to have to show some sort of, incorporation article, and now with all the regulation around beneficial owners, it's becoming even more burdensome. So you have to juggle the regulation piece versus the innovation piece, which is interesting.
And there are innovations that are coming out to tackle some of the new regulations, but I think, a lot of it is the data quality that's out there. So how much you can automate based on the data that's available on these businesses is not great.
Yeah, I've seen Stripe just basically let them come in and transact right away, but then it's limited to, let's say, $5,000 or something, so you can put a risk cap on it or something.
So when it comes to simplicity, I think about the things that both of your firms have done. What was the sort of idea, the genesis behind the founding of Secure and with Alloy? Either one can go first. Why don't we go with Edwina because she's sitting closer?
Yeah, sure. So I think, the idea, the founders of Alloy had experienced this problem in their previous startup. They knew it existed, and it's exactly that one problem that they wanted to tackle, that they wanted to improve for businesses. And we talked about, David, you talked about at the beginning, there's a lot of consumer, sort of consumer-facing businesses or fintechs that tackle that one bit, and that's how they get their customer base.
Yeah.
But it's the same principle in any startup. You have to start small, you have to start focused, you have to find that thing that's going to work, and that's how you can grow your business.
And what was the thing that you found that was going to work, that Alloy found? What is their thing that they're fixing?
So we're fixing the decisioning piece around identity to automate decisioning.
And Secure.
So Kira, co-founder, Sunil, moved from Scotland to the US, and he soon found out that, he had great credit, access to all financial services in Scotland and in Europe, but here in the US, he really couldn't, get any credit. Identity has been predicated upon you having credit, right? It's been managed by these big bureaus. If you don't have a credit card, then you're not in those credit agencies, therefore you don't have a digital identity. So Sunil, with our co-founder Johnny, set out to build a product that could identify. Essentially, our goal is to identify everyone in this planet. We're starting small with the U.S., but they set out the goal to use alternative data sources like social media. You're surfing the web, you're leaving all these breadcrumbs all throughout. So we're going out, collecting all of these and forming these holistic profiles on consumers that then we're able to tie with stronger signals that come from other actions that you might have taken, opening up accounts, setting up utilities. And one of the pieces that we have a big focus is precisely around simplicity, right? Like, it's a very, complex mathematical problem in the back end, right? All these machine learning algorithms running, but when we output a score, how do you interpret that? What does that mean? And really normalizing that score to be significant and action-driven.
So when you say scores and you think about things like this, obviously you think of the FICO scores and things of that nature.
Yeah.
So and we think a little bit about the probably overused word disruption that has come about with fintech. So how do you think about when Secure, do you see it as a complement to what's there? So do you see it as something that could supplant the legacies?
So no, we don't think about it in the FICO score sense of the word. Actually, the way we think about it is, it's a score between 0 and 100, and then businesses build their risk strategies around their riskiest percent of their population. So, for example, credit card, right? They want a decision off of the 2% riskiest population of their business. So a score from us would be 0.98. It's very intuitive. 0.99 represents the top 1%, 0.97 the top 3%, and so on. So you can start building strategies to manage risk around the riskiest distribution of your population. And that's how we're able to categorize it. And not just for that particular customer who's integrating us, but everyone within that industry. So we have multiple credit card lenders, right? We aggregate all the data we learn from everyone there and start normalizing the distribution.
You guys are mostly focused on onboarding, but how does that relate to, because we had an event very recently on payment fraud, which is a related area, but it's a little bit different, I guess.
Yeah.
Do people use your stuff for transaction scoring, or is it mostly for onboarding?
It's mainly day zero onboarding. So there are companies out there that are doing transactional, Feedzai, some of the big players there. I personally believe that that's going to go, that market is going to shrink down to biometrics, right? If you see what's happening with the another acronym, I'm not quite sure what it means, but the W3C and FIDO Alliance being able to support biometrics with browsers, right? Now you can authenticate your MacBook. Think about it, you have that fingerprint. So when you think about transaction fraud, it comes and derives out of the authentication space. Identity, you have verification, first time seen, and then ongoing authentication. Is this who I've seen before? So very different.
Edwina, on your side, I mean, you talked a little bit what they do. Who do you target? Who are the people you look for to use your products?
So we work so closely, it's very similar. But so you're working with banks, working with fintechs, anyone who focuses on their digital customer experience, that's where we really can come in. So we can help automate decisions. So when you do sign up for a product, it is the experience as a consumer that you're looking for, which you have with all the other technology products. And by allowing our customers to kind of bring in guys like Secure, then we can help reduce the fraud risk right down for our banking customers.
And not only products, right? Like a lot of the time I'm talking with our head of sales and we're targeting like chief risk officers, like the fraud teams, but you want to be talking to the customer experience folks. How do I reduce friction on onboarding, get rid of the annoying questions like where, what's the square footage of your house from 20 years ago? Like,
which street did you not live on?
Like if you start looking at attrition rates when it gets to that point, not only are they not effective, but you're losing good customers. So we also take that angle, and like Edwina said, partners like Alloy are great for orchestrating all those decisionings that can be complex.
So you guys aren't trying to build a brand yourself. I mean, it's a brand, people you want, but it's not a consumer-facing brand. People are going to think about this. But David, you mentioned earlier some brands that have started to build their own brands and that do have the potential to grow big and actually take share rather than complement something that I'll call them the legacy players are doing. So talk a little bit about your thoughts there. You said company that could become the next Amex, which perks my ears of having spent 13 years at Amex.
Yeah, I mean, I think when you look at the way investors are evaluating, some of like companies like Robinhood, I'd say Robinhood, Stash, Coinbase, SoFi, and a few others, Wealthfront I don't really talk about. That's how they're thinking about it, right? They're thinking about how do we build a next gen bank or a neobank, and you have some more neobanks entering the market. I think in the early days, like it was, the business models didn't work for sure. Like Robinhood had a shitty business model. I think Acorns didn't have much of a business model early on, but now they've reached, Acorns, for instance, has 4 million customers, and they're starting to rebundle. So now they're launching an IRA, they're launching a card next month, and all of a sudden it starts becoming pretty meaningful. Because as long as you have investors that are willing to fund the growth, as we know, right, a lot of those products are also not profitable. But when you get down the line to the, to the mortgages and to some of the other, products that banks are offering, then it becomes I think that becomes a real threat to the incumbents. When people start to make, and we'll find out in the next year or so, if consumers are willing to put their direct deposit into a fintech versus a bank. And
You think in neobanks now?
yeah, or an Acorns, or if you look at SoFi, right? Student loans are navigating your student loans and getting a better rate and saving some money on that. That is the highest pain point that somebody can have in financial services. So if you help them figure that out, it's a very easy sell to say, hey, I'll also give you my mortgage, I'll also give you my savings, their savings product. So I think that's really starting. And you look at something like Coinbase, like when's the last time you saw a bank or anything in financial services had a wait list other than like the black card at Amex? When has it been?
There's a wait list?
There was,
okay.
I don't think there's one now, but it's also not a far reach to think that if crypto comes back and people are still excited about it, they could also try to pivot into more traditional products.
So I see this as Fintech One, these consumer-focused brands
Yeah.
which did the whole PR, banks are terrible, they'll never change, we're going to eat your lunch, blah, 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 blah. And then Fintech Two is looking more at the B2B side of things and the difficult problems which people aren't as familiar with, investors aren't as familiar with. It's harder to understand how this is going to work, how this is going to scale. But it doesn't mean there aren't massive opportunities on the B2B side of it as well, but they're just not, consumer brands that we're going to aspire to, that everyone in the day-to-day will know about.
Do you think from the investor side, being one yourself, that there's a different appetite for the kinds of things that Secure and Alloy do than somebody who's going to, say what you want about Uber, but that's a brand that everyone knows now, and now where it's going to be in 3 or 4 years, we'll see. But
Yeah.
from an investor point of view, is it infrastructure is not as interesting as building a new brand? Is that a... I don't know, I'm posing the
Yeah,
question.
no, I mean, I think if you look at what venture capital was 30 years ago, right? It was one sliver of an asset manager's allocation to truly moonshot ideas, like, building the internet, like space travel, those sort of things. That's like what venture is by definition. And the traditional, like the VC firms that we all know in Silicon Valley, a lot of them came from Silicon Valley, and then another batch popped up during consumer internet, and they really sat at the center of the universe they helped create. When you look at venture dollars being the capital source for industries that are not similar to consumer internet, like we're in this transition period where you have investors that are still evaluating companies as if they were the way they've always been evaluating them, but
And that was as more consumer facing or
more category creating.
category creating?
Like search
Yeah.
engine versus SMB lender that's going to be constrained by the amount of capital they can raise. So I think it's a good thing because it is getting companies started and it is getting companies funded. And to answer your question directly, I think the market's getting smarter. Like I think investors that have been investing in fintech have been doing so for like 5 to 8 years now. So they're starting to say, wow, the enterprise sales are really hard, but once you win those key beachheads and get over the hump, it's pretty defensible because these large companies are going to rip out a solution once they commit to it. And we're actually a very big enterprise investor. So like if you look at mortgages, there were, probably 3 or 4 big companies that came out and said, we're going to rethink mortgages and why can't you get a mortgage on your phone? And similar pitch we've heard for a lot of other things. And we invested in the business that went and said, we're going to work with companies that have LOS systems that don't talk to each other. And we're going to build a software.
LOS systems?
Loan operating system.
Thank you.
Is that servicing?
Doing the acronym play.
Origination.
Yeah.
Yeah, so if you're a big mortgage lender and you've got through acquisitions and you've got all this tech debt that you've accumulated over the years, going in, because the original pitch from fintechs was going in and telling them how terrible it was. And they're like, yeah, we get it. Like it's spaghetti, it's a mess. It's our world. And that changed to, well, let us give you a solution where you can actually offer that modern life, where you can offer that. This is no different than anything we've talked about, Stripe and all the others, where you're not fixing any of the infrastructure problems.
Like you said, they're still there.
But you're giving Wells Fargo the ability to offer a product where somebody can get a mortgage on the phone. And that allows them to be competitive in a market where they're going to be competing against these other fintechs. But I think when you look at some of the products that have been built in the fintech one or the direct-to-consumer sphere, they're pretty compelling, right? Like getting term life insurance with 3 clicks versus having somebody come to your kitchen table and try to sell you the policy that makes them the largest commission, and then it takes 6 months to actually get the policy bound. Like the products really, in some cases, are superior.
Does that era pass? Have those things been found, and now we're going to more sort of Stripe is an infrastructure play, right? It basically simplifies the infrastructure coming on board. It's not something that says nobody who's not a developer or a website person knows Stripe. right? They're not selling. So is there anyone coming out in this day and age and trying to do that has been successful, or was that early on when there were, to use the cliche, low-hanging fruit that could be identified?
Well, I mean, I think that quickly blends into the crypto discussion.
Uh-oh.
Which is, no, it's like, is there a case for crypto? It's like, sure, when new products emerge. Like, unless you're solving issues like on the fringe of the organization where you can find a wedge in and then obviously land and expand. But if a new product comes up and you were to look at it and say, all right, with everything available today, all the tools that we could possibly use, there's a chance that gets mentioned in the conversation. But I think it'll come in the form of like a brand new transaction that's not happening.
So whereas you guys, like when you approach a firm, who do you typically go after as customers? I don't want to pry on your strategy, but who would you typically think of as Edwina, for example?
Do you mean?
Who would be the people you sell to convince?
Yeah, so people in the digital product side.
Of
Banks or fintechs.
Okay, banks,
Yeah.
okay. So you go to banks and fintechs themselves. And I know you've only been there a year or so, but have you seen the appetite or the interest of banks to what you offer change, or has it always been easy, or has it always been hard, or?
So far so good. Yeah, it seems to be. If we talk to people in the digital product team who are looking to transform the way that the new customers sign up to their services, then they are, pretty blown away by what this can add to the existing processes.
But you got to talk to someone in that digital team.
Typically it helps, but it could be a range. It could be a whole.
So if you went to a smaller firm that didn't have digital focused specialists, it would be harder to sell?
It may be, particularly if they aren't prioritizing it. That's part of the problem about being a fintech as well. You've got to hit people when they are thinking about the problem that you're trying to solve.
Yeah, I think that with banks, it's particularly a challenge, right? You probably have, as a vendor to a bank, two windows within the year where they're going to onboard new vendors. If you miss that, it's like, for a startup, you can't afford to wait another 6 months to then start the vendor procurement process and all the analysis that can drag you out for 18 months.
Yeah.
So that's a real challenge. Even though the bank acknowledges, we have a problem, your solution solves for it, there's just so many levels of bureaucracy around, you're touching, specifically within our product, we're touching personal identifiable information, PII, right? Like they want to make sure to the teeth, like where is it going, where is it being stored? It scares the hell out of a lot of banks, like, oh, you're in the cloud, right? Like we're using, and honestly, it's more secure than probably their own server centers. So getting over that, talking with legal, the contract, it becomes a real burden, even though you may have like the right product that solves for their needs. Now, with smaller companies, it's obviously they're a little bit nimbler, easier. You go straight to the top, to the decision makers, and you can push in. And then when you have other partner channels that are already integrated into those banks, then it becomes an easier sell because you're going through those vehicles. So it's not as straightforward as one would wish for.
Which is very different than building your own brand and getting out there in front of people when you don't have to worry about that as much. Yeah. And
I mean, our view is that there's going to be both. It's just, you're going to have fintechs that are going to be very successful, and you're also going to have people that are never going to bank with a fintech. And to the extent fintechs can produce superior products, it's going to increase the table stakes for the banks. They're going to have to build products that compete with that. And if they live in a world where they can't build their own products, then we think they're going to turn to the fintech market and work with startups to build it.
was that something that has happened, or is it? I think it might. Yeah, that's kind of.
Well, that shift happened.
Yeah, that's what I thought. That's
3 or 4 years ago.
With Braintree, right? That's why they got acquired. They were investing, it wasn't going far. And they're like, all right, we give up. We'll just buy a fintech. You have this bank mentality where we have all these data scientists, we have all these engineers, we have unlimited funds. You need a team. Here you go. Here's a team. Go build it. But quite honestly, you're just spinning your wheels, and it gets to a point where look at what happens with Capital One and their mortgage business, right? They just shut it down right now because all these other fintech players are just that much more efficient than underwriting, managing risk, lending out money. They're just taking a step back and acknowledging, sink the cost, right? Like step back and look at it for a couple of years, maybe go snatch up a company and then get another head start. To your point also, you have all these systems that are just not talking to each other, and a fintech that has a greenfield project can move a lot quicker at implementing efficiency. So
I think another thing that is worth noting is like management's focused on, you know, their public companies. They've got a different area of focus versus, you know, let's go into market and test new ideas with customers until we hit something. And if a bank decides they want to go test with market, it's going to cost a few $100 million versus.
And that's going to hurt them at the quarterly?
Yeah, and then versus waiting for 100 startups to try and then going and partnering with the two that hit on something.
I have a question in terms of investment. Very recently, I was on the West Coast and I was talking to someone who's in the fintech space, and she was saying to me, the investment threshold and like the criteria for investors in the West Coast is completely different than Europe. It's almost like she had completely different conversations. Questions were different, focus was different. Do you find that to be true, that there's just a different mental framework of what constitutes potential and value?
Yeah, 100%. You know, I guess I look at fintech in 3 buckets. It's, you know, providing something brand new that doesn't exist today, which is obviously, I think the Silicon Valley folks are really good at that. You know, creating a marketplace. An example of this would be a company called Roofstock.
Roofstock?
Roofstock. Yeah, so you think about all of the single-family homes that, you know, like that large private equity funds purchase post-crisis from Bank of America that foreclosed on.
Like all the cheap homes.
So you have these really, you know, you have these really large financial players that were holding homes, and you're like, well, that's not your business. And what Roofstock did is they created a marketplace where you could trade single-family rentals between investors, the actual home. So if you're a Chinese family office, you can register and get onboarded, and if you're, I don't know, Blackstone, you can match to a buyer and, you know, trade out, and then underneath there's a property manager that will actually.
It's like Airbnb, but for long-term rentals.
It's like eBay, but for property.
So
I
blockchain?
have an amazing use case for that.
It's not.
Around
But it, you know, it's one of these, and I think you found this post-crisis too, where it was, you had like all the online lenders. Post-crisis, banks exited unsecured lines of credit for consumers, and then Lending Club and Prosper came and said, we'll take that business, right? So I think that's one bucket. The other bucket is consumer. And I think in consumer, it's a very, you need to raise a lot of capital, and it takes a lot of money to build a big brand, and that's the stuff they run towards. And then I think you have the third bucket, which is, you know, a vendor, a software provider to incumbents. And I'd say.
So is that more like here? That would be third bucket,
Yeah.
bucket 3. So let's go back again. Bucket 1 would be
Brand new category.
brand new category. So the platform, the whole idea. And then the second bucket,
New brands.
new brands. Okay, consumer brand. Okay, and then you're basically B2B supplying the existing
Enterprise
players.
software providers today.
Yeah.
And I think it's pretty broad because it goes from everything from fraud to chatbot providers. But in fintech, that's kind of the funny part about fintech, right? It's like, if you sell to a bank, you're a fintech, but you could be selling, you could be selling, you know, some sort of security feature or something like that.
And I think just like if you're in New York, if you're in London, you're more connected to the actual finance industry than you are out in the coast, in the Bay Area as well. So that'll impact your investment mentality.
Have you found that about when you approach a potential customer, depending on where they are physically, where they're located, that the sale is different, it's harder or easier?
For the customer,
Yeah.
Interesting. I don't.
Well, someone made the comment. I think Maria made the comment about in the Bay Area, the selling whether
Well, this was around raising capital.
raising
It
capital.
was like
Yeah.
a completely different conversation. Criteria.
So investors, yes, but our customers are just spread out across the states.
So you don't see any particular regionalization or certain areas that are more sophisticated to it.
Probably the biggest difference is selling into fintech versus an established bank or even.
So I
even a
can
small
guess the
bank.
difference, but tell me what the difference is. Say small bank to big bank.
So, small bank to big bank. Big bank processes. It's the 18-month sales cycle. It's the stakeholders. It's the different departments you need to get approval from. It's the due diligence processes, security processes, etc. Contracts.
Which, by the way, is generally how much capital a company gets in a round, is 18 months.
Oh, so it's an 18-month sales cycle, and you've got 3 clients, and you're going to run out of
No,
money.
when you're leading a Series A, it's an 18-month runway, and then the reality, the environment they're living in is, you're meeting with banks, and I think one of the things we caution everybody against in our portfolio is that if you're not making progress with an account, you really have to move to someone that's going to act, because the clock's ticking the whole time.
Yeah.
It's not the world you live in on the other side of it, where it's like, I want to get educated on what these new solutions are. It's
Your
pretty-
first clients as a B2B fintech can't be the major players, because you'll never get
You'll never
the
close.
time.
Yeah.
They have to be the small guys.
And so smaller bank.
Smaller bank is easier typically because they can see the benefit. They've got the decision makers, which are normally working with you from the start, so they can see the opportunity and they can help, help guide you through their internal processes. Not skipping the security, not skipping the due diligence, not skipping the legal contract, but just being a slightly more flexible for a fintech and being able to
Time versus the big bank to some small bank. Just ballpark.
So
if one's 18 months, what's
one could be like 3 to 6 months for a small bank.
good. Okay, now selling to another fintech.
Oh, that could be a couple of months.
An afternoon?
Yeah.
Yeah.
An afternoon. Good.
Tommy coded our secure API, the new version, like in something like within a day. And when we take it to big banks, they're like, "Oh, we can't get this upgrade in until the next cycle, next semester. So sorry, we're gonna have to pause on it for a while." So it's crazy. Like technically, it's not hard to integrate it, and they do have the resources, but just the whole bureaucracy behind it is really, really crazy. And then from our point of view, given our product suite, we for those smaller banks, we tend to see they have like cores from the Fiservs. They're providing all these FIS, all these tools. So if you integrate with certain partner channels, then they take care of like the sales cycle for you. They're already integrated, they're already approved, and it just becomes a flip of a switch for those smaller banks. Versus like the larger ones, the top tiers, they manage some of their own cores, manage some own workflows, and they're trying to figure out where do I plug you in along with the other solutions that they have. So Secure, typically when we're implemented, we're not the only solution, right? We're partnered alongside with some of the usual suspects that form that decision making for those banks. It's a little more complicated.
Now, thinking forward about being in this business, watching it from different perspectives, what of the new technologies that get talked about a lot do you think are going to have the most impact over the next 2 or 3 years? I mean, this is your blue sky. Open it up. No one's holding you to this, but we'd love to hear your opinion, kind of thing. Yeah, any of you guys. I mean, we've got AI, we got machine learning, we got. We could use the scary word of crypto.
I think. Well, you said AI, right? It's the way we see it is just barely getting started. A lot of the AI applications that you see today are, quite honestly, they're supervised. So there's someone like really feeding back training data sets, adjusting a little bit, letting the machine run its course, correct it a little bit. I think it'll be really, really interesting when these systems become so sophisticated and a little scary, but they just fully become unsupervised, right? And you can really take a step back and let it run and start building its own decision trees. And then another side of it, just by nature of the industry that we operate in, there's this term that's often thrown around, and it'll be interesting who and if it really gets cracked, which is self-sovereign identity, right? Like where you own your identity, you own the keys to your identity. So when you're talking encryption, all of your information is, within the device, right? Like today, Apple Pay or the sensors on the device, when you put your finger on it, it scans your face. All of that information is embedded locally on your device and never leaves it. So there's this concept.
Does that fit the definition of self-sovereign identity?
Well, it becomes where, like, you can manage the permissions of what elements of your identity you share with certain businesses. So take, for example, Uber. They don't have to know my date of birth. They don't have to know even my name. They have to know that I'm good for this payment and where I'm going, period. Banks, for example, yes, you have to know, my date of birth, my social security. Can they do business with me? Do some watch list checks, like you disclose more information. So there's different, depending on what or what merchant you're interacting with, depends on the level of information you share. And when it's truly self-sovereign, then you can manage those permissions. And it'll be interesting, with applications like the blockchain, how that evolves. But
Berners-Lee just launched the other day, and I just read one story about it, a new version of the web. What's it called again? I think it's self-sovereign. It basically is the idea that your information is in a capsule that you disclose when you need to.
Yeah, so he's going after that, right? Like the grandfather of the internet, he didn't say much about what they're doing, but we believe
I put my email on the let me know list. What about anybody else? Any other thoughts about ideas that will be the big ones over the next 3 to 5 years? I mean, you guys invest for more than a 3-month horizon.
Yeah, I mean, I don't know. I still like crypto. Like I know it's not in vogue right now, but I feel like
Crypto or blockchain?
Crypto. Well, let me tell you how I think about crypto. But I think Bitcoin's a proof of concept, right? I think it promised to be borderless, anonymous, a better payment system, secure. It's none of that. It's actually lousy at many of those things. But what it's done is it's inspired groups of people to work on each of those problems, right? So whether it's privacy coins or stable coins, which should be coming out in the next quarter, they're saying we can give you a digital token that's not volatile. So if you want to, if you're in Venezuela or if you're in Argentina right now and you just want to transfer your savings into something other than the local currency, like presumably you could do that with a stable coin if they launch and work. And I think there's, enterprise blockchain was kind of like a pivot by companies that didn't work to outsource their devs to like become enterprise software companies. And like some of those are doing well, but many of those, there's like 3 left in the market at a time. There's like 20 enterprise blockchain companies. And what I find really interesting now popping up is there's, which I don't think this idea is crazy at all. So like when you finally like work your way through crypto, you have utility token models, which I've yet to see one that works, but there's a few out there where, they're essentially payments where you're trading services or you're borrowing other people's cell signals and stuff that just doesn't happen today, where if you were going to map everybody's cell reception in this room together and compensate everyone, you're certainly not using the networks for that, right? You're going to need a new payment solution.
So it sounds like.
And then the last piece, which this is what I've been getting excited about, is
I want to see you when you're excited.
Is basically tokenizing traditional securities. So if you have equity in a building, or you have debt, or you have mezz debt, just creating a token out of that and basically using tokens as the crowdfunding.
Right.
The underlying technology.
So you can basically take small pieces of it and actually invest in that way.
Yeah. So there's a few ideas right now that are saying, hey, you want to go and buy a trophy asset in Manhattan, you want to syndicate out 10% of the sale price. Right now, nobody's going to do that because the administrative cost is just too high with lawyers and paperwork back and forth. But if it was, this is a registered, whatever the instrument is, and you're registered on the other side as a qualified buyer, you can just transact. I think that's going to come out in the next 1 to 3 years.
And were you guys investing in ICOs and within your?
No, we didn't invest in ICOs, but every ICO now you see is registered. So
There's an article into this week's New Yorker by John Lee Anderson, who's a good writer. Writes from a lot about just that. He's going to a crypto conference. He's talking to Vitaly. I always get his last name. Yeah, and all. It's just fascinating because he goes at it from the point of view of, I wanted to wait and hope it would pass, but now I have to really understand it. And I'm halfway through it. But to your point, bringing it back here, it sounds like this is at such an early stage that 15, 20 years ago, it wouldn't have gotten the publicity it got because there would have just been a bunch of guys in in front of the computers just swapping notes, but somehow, for whatever reason, this became a big thing, and it became, something one could invest in, which heightened the awareness of something at a far earlier stage than it's really ready for public.
Absolutely. And both on crypto and on the enterprise blockchain side as well. I know there's quite a few people looking for a problem to solve with their blockchain. But I do think it's pretty interesting, and there will be some application, but it's just taking a lot longer to go to market.
Anyways. Any other main points you want to bring up? I mean, there's still beer to drink, there's still questions to be had. We're always open for other conversations.
And an interesting, so I was down at the BAI conference in Orlando the other day.
Yeah.
And so 3 years ago, one of the founders of Monzo stood in front of us and was like, Monzo, this is what we do. Look, I can freeze your debit card that you've lost, and now we can unfreeze it and you can use it again. And everyone was like, wow, this is the future. And at BAI, one of the top banks in the US got awarded. They got the voter's choice out of the whole conference because they'd developed this, and they had an advert around how you could freeze your card on the go and then unfreeze it. So it's
those capabilities have been around for a while. When you look at like the messages that banks interchange with Visa, for example, ISO 8583, there's a parameter that you can send it. Just like no one had really opened it up and paid attention to it, and their pamphlet to their defense is about 1,400 pages, but still that capability has been around. And always it blows my mind that it's such a recent development.
And will this, to your point, David, about the low-hanging fruit, will this kind of low-hanging fruit that these guys started with, will they be able to maintain their competitive advantage by kind of?
Is there a competitive advantage?
Yeah.
I mean,
well, there was in the brand, on the consumer brand.
Yeah, in the consumer brand.
Yeah.
I mean, Dave and I were just talking earlier about investment and the part of, no, it was who was I was talking to somebody else in here about a company that went public on the basis of what they thought was a strong competitive advantage, but we're working in the market, Deb and myself and one of our other business partners, and it's not really there. Mm-hmm. So it depends on how far you can get. Mm-hmm. But you can get a fairly good, the simplification, for example. I mean, look at the simply making something easier to do, as we talked about earlier, can get you a certain way, even though it may not be defensible in the long term.
Yeah.
But, so. Anything else? There's plenty, there's beverage, there's conversation to be had. I want to thank you all for coming. And you're on the mailing list now, so you're in trouble. We don't spam you, but we will be sending out something in November saying here are some of the topics that are floating around. We always want to figure what are the good ones to put on the agenda. And so please, it'll be a 2-question survey. So when you get that, please do take the 3 or 4 minutes to respond to it. And I want to. Anything else?
You're gonna take questions, or?
Yeah. It should be questions all along. Ask questions.
Okay. So I have a question. This is to anyone who wants to answer, but perhaps Eric, will start with you because you brought it up.
You're so formal. The questions are all through.
Self-sovereign ID. What about the concern people have, in terms of their own identity being stolen? People are already worried if their credit cards get stolen or if other information like their birthday gets stolen or their birth certificate. Now we're talking about characteristics that are inherently theirs. So how would you address some of the concerns that consumers may have about those security concerns?
So, first of all, some of the big breaches, like all of our information is already out there. So let's just face it, right? It's reality. I think the reason these breaches happen is because you form these what they call honeypots of information, right? And if you run like a security scan, like a lot of them, they're using open source software, right? Which is a great thing, right? Because there's pieces that work really well, but like there's always vulnerabilities happening, so you have to stay on top of it. You have to have a good security team, engineering team that's on top of those pieces and always a step ahead of any potential vulnerability. So there's always a chance for a breach. What happens with self-sovereign is that you own it, you decentralize it, and you don't create a honeypot where attackers can have vectors into. So if they want to get the identity of Eric, for example, they have to target me specifically, and then if you do things like encryption.
So it basically says you have to launch a zillion little attacks rather than
Exactly.
attacking 3 different storehouses of
Big
information.
honeypots of information.
Yeah. So it's like a honey speck, not a pot.
Precisely. I'll start using that.
Okay.
But yes, so that's how. But then the question becomes like, can we trust consumers to manage their own identity? One of the biggest, the hardest problems. If you lose those keys, it's really hard to get them back, if not nearly impossible, depending on the recovery mechanism that these companies have. Coinbase, for example, if you lose your 2-factor authentication, they put you through a whole nother. It's pretty complex. So can you trust consumers to safeguard those keys to manage it?
And who verifies your identity in the first place? And do you, for example, does there end up being an additional body or two within that?
Yeah, so it's a bilateral adoption, right? The consumer has to sign up to get those keys, and then the merchant they're interacting with has to be able to communicate with that channel. So that's what makes it very complicated. It's the bilateral adoption. I don't think we're ready for it. I think we'll see certain companies, and it's already happening, right? Like you already see a few Civic. There's a couple Cobalt doing it, but they're not really getting a lot of traction because of that bilateral adoption. Consumers tend to trust, ironically, their banks to manage their identities and the government. So it's like it can't be more prime for disruption at this moment.
But that's an interesting point, though,
But
because
isn't that real? To your point, isn't there a perception versus reality where you guys, with all respect, have far greater technical knowledge than all the consumers out there put together, right? You've forgotten more today than they'll ever know. So you also have to manage that marketing of that and that perception where people feel like, even though you had Experian, well, my credit bureau is better than me having it on my phone.
Yeah.
And it's like, it's crazy.
No,
yes, but I think it's one of the big disconnects I see a lot of times, in that a technically elegant solution, in my opinion, won't go anywhere in a consumer-facing product if you can't explain it really, really, really well. And I mean in like 2 words.
Right.
Because otherwise, it goes right past it. And so.
When we began the conversation about the undervaluing of ease of experience, it's like I can even want to manage my sovereign identity cognitively. Like I even actually understand what that would be as a value. Okay.
Yeah, and
now
then,
I have to do stuff.
Yeah, exactly.
I have to get back to all the stuff I have to do today, and
which is why you'd rather have most people, I won't say, would have a trusted third party. And one of the people I know who thinks about identity talks about having a financial institution, a bank, as that trusted layer, just because it'll work, as opposed to trying to educate masses of people to manage their own identity is going to be really hard. But I mean, I would play with it, but we are an outlier in the general populace, those of us here.
It's true. It helps talk about upcoming fintech trends with people outside of the fintech universe.
Yeah, well, I mean, the bubble is always something we have to burst out of. So,
yeah.
But I mean, one part about these conversations is it helps us think a little bit more about it, and with luck, translates this in a way that we can explain it to other people. Thus, meaning we understand it better, and maybe someone else we talk to does. So,
I wonder, you were talking about different types of fintechs, like consumer facing, and then what I would call what you guys are doing, which is infrastructure. I wonder how it's divided up. I mean, like, the consumers know just about the consumer facing ones, but us bankers and fintech participants, we think of companies like yourselves who are helping us, and I totally see why, banks are now open to this, because banks have been using companies like FIS and things like that, and the way budgets are going and things like that. There's no way they're going to begin to have that kind of database that you have, or that kind of AI or anything. So it's just every size bank, it just makes more sense to buy it than to build it. But I'm just wondering, is it like, how big is the market in these 2 sectors?
Well, I mean, so there's very few fintech funds, and they're all pretty new. We're the second oldest, I think.
who's the other ones?
It's Ribbit, QED.
Ribbit, like a rabbit.
Us.
Oh.
And then there's it's a half a dozen early stage enterprise fintech investors.
Everyone else was just a
And if
bigger fund that took a little dabble in fintech.
No, I think they're going after more consumer, more like category creating ideas.
Yeah.
So if you have like the fintech partner at Sequoia, they're looking at something different than enterprise fintech. And it's even more extreme in capital markets. So there's like 3 investors in Wall Street ideas. And it's very similar to like the world you're living in. So
I think you get a lot of corporate VCs as well that are investing in the enterprise fintech stuff.
yeah. And it's just, you know, it comes down to if you think you can attract enough capital to build a really big business. And I think as long as this cycle lasts, I think the investor community is going to get smarter and smarter, and more people are going to become interested in enterprise plays. But we're also 10 years into that cycle. I don't think it's gonna
Is 10 years into it mean early into it or late into it?
I mean, crisis 98, 08, we're in 18. Like,
It's kind of, I mean, an enterprise play. No matter how big it gets, it doesn't have the potential of a consumer play.
and there's this
No matter
balance.
how big the potential of your company, which is a good sized potential, it's never going to be a Robin Hood.
That's right.
You know, it's
And
a
I
very
think-
different thing.
But it's also the downside side. You
Yeah.
know, it's not as risky, right? Because if you are getting traction and you have a client, you know, you have a solid customer base, you're gonna have a good outcome. The trick becomes when consumer companies actually can't pull it off and then want to pivot to enterprise because they're too expensive, they're overvalued.
Yeah, and they've been focusing on just growing their customer base rather than figuring out a solid business model, whereas enterprise has to have the business model pretty well nailed down for investors to give money rather than focusing on just pure, numbers. It's like how are you making money? So it's treated a little differently.
So to reframe that point and make sure I've got it, if you're consumer facing, you can talk about acquisition, number of people on board, get funding based on that, figure out the business model later. But when you're enterprise, you got to have the business model locked and no one will pay attention to it.
I believe so, yes.
And also on the consumer side, there are so few fintechs that have acquired over 1 million customers into a new brand that when you see something on a path to have more than 1 million, it's a big deal, right? Like Robinhood went out for their A, they had a wait list of 500,000 people on their, that had signed up for their email to say like, let me know when you launch because I'm going to sign up for it. And that was kind of unheard of.
When they launched the crypto trading, there were how many accounts in 3 days? Like
Exactly.
millions. I think they were looking at like 1,000 transactions per second, literally.
And then if you look at all the other ones that aren't Robinhood, it's like a handful.
Yeah.
You know, PayPal, Venmo wasn't that successful. Venmo was like a mistake.
Well, Venmo,
It's like a
they
what?
announced they're increasing some of their, because they haven't figured out the business model yet. They can,
Yeah, no, I saw that this last week. Yeah,
If you want instant transfer on Venmo, you have to pay more.
yeah.
yeah, no,
The
I
whole
saw
idea
that.
was an instant transfer model, right?
Which
Well,
probably makes
remember,
more
that
juice.
company never worked, right?
It's not
Like, there were
profitable.
8 people and they sold it to Braintree because it was a talented tech team. And then when PayPal acquired Braintree, they got Venmo.
And they didn't even, like, I hear they didn't even know or realize that they were getting Venmo. And they're like, what
Okay
is
with
that
it,
thing?
Not, then you read their annual report and it's like, they highlight it. So.
Right.
Yeah, I understand you just mentioned that Robinhood had we'll call it a sizable wait list of customers. Doesn't that kind of pale in comparison to what the 4 largest banks in the United States have? Or let's throw out the 4 largest banks in the United States and let's just talk about the handful of regional players. Don't these startups still pale in comparison to the legacy infrastructure that exists today that they have to overcome to try to pirate away those customers?
I mean, I think on every metric, right, it's smaller. When you take into account that company had only been around for 1.5 years, and they've built a product that 500,000 people were interested in hearing about before it was even launched, that was like a big deal. You could also argue, well, the initial Robinhood product was stock picking, which no one should be doing, and it was pay for order flow, and then, which is a controversial topic, and margin lending. So like, you could sit there all day long and look at that Robinhood example and say, You know, you shouldn't be stock picking. Pay for order flow is a practice that's going to go away. Selling off order flow to high frequency traders, and now you're giving stock pickers margin, right? Like it's not a good thing. But I think what is different and where the incumbents pale in comparison to Robinhood is the experience, right? That's a fun, interactive, easy to use experience in a way you can't get at a bank, right? Like why isn't Zelle? Zelle's publishing all these massive numbers of people enrolled, but when you look at the actual volume, like, why isn't Zelle taken off? Because people don't really care about TD transfer. They don't want to dig through. Like when I log into my banking app, right, there's like 50 things going on. So like digging to find the Zelle portal, it's a habit I've formed, right? Everybody's in Venmo, so you kind of go to that. So I think that's the big thing, right? It's not about functionality. It's not about the tech stack. It's not about price. It's more about design thinking and creating products and financial services that look and feel like the rest of the stuff you're using on your phone.
I would argue not in every metric though, because when you look at even take the top 4 largest banks and take the top 4 fintech neobanks, I can assure you that the neobanks are opening more accounts than the banks. In fact, the top fintech
I wouldn't go there.
Maybe more than the top
I wouldn't
3.
go there only because the big banks open a ton of accounts. At the same time, they close a ton of accounts. And this is an old metric on Chase. I'm going to botch the statistic, but while I'm going to say they were opening hundreds of thousands of accounts in a year, they're also closing hundreds of thousands of accounts. And again, I don't know what the exact number was.
And then
there was a lot of
sure, is still higher.
Again, I'm not here as an advocate for the large regional players or the 4 largest banks. It's they currently have the customers, and sometimes what I feel, because the word bubble was mentioned a couple of times, the pent up demand is what I think is reflective of the wait lists that we're seeing on a Robinhood or what's going on with Acord. I mean, just take a look at all these different fintechs. They're all throwing on payment services. Got a wait list on a debit card. I didn't get in the first round on a debit card on multiple different places. They want to start providing the simplest banking services, which is payments or what we call checking account proxies. And it doesn't take much to extend to checking, savings, and that's a legacy term because these are products that are thousands of years old. But we're taking these modern companies on a modern stack. They are encroaching in mass. And we're sitting here, the scale is at the incumbents, but we're all the products and services that I think the pent-up demand is. And I'm still trying to situate, and you called this Fintech 1 and Fintech 2. I'm still remembering a whole bunch of companies that I'm going to call Fintech 0, that's going on here. And I'm still unclear as to where this is all going to shake out.
I mean, I think you're in a period where you have a dozen companies that have enough scale, not scale anything close to what the incumbents have, that are going to start the process of rebundling. And the one signal to look for is if people are willing to open up a checking account and move their deposit to a fintech. And I think that's TBD, right? But if that happens, that's a big deal. Like, that's the linchpin to the banking relationship.
That's going to happen, though. I mean, because there's going to be added value that aren't going to be
The example I was giving earlier is that I tried transferring money from 2 accounts I had at Merrill Lynch the other day. It required a wire and a tape, like a fax. And,
A fax?
Yeah, like an electronic fax.
Like an ACH.
And I had to do a recording.
US to US, ACH account.
Because it was a business account to a personal account, so it's different systems. I don't care about that.
Yeah.
I opened up Acorns when they launched their retirement account. You sign up for an IRA in 2 clicks.
Right.
Like, they're like, hey, do you want an IRA? And you're like, yes. And they're like, click here if you want to learn what it is. And then it's like, how much do you want to put in the month? And it's open, right? And like, that's more design thinking, right? That's not.
Well, we did a whole event earlier in the year about how user experience is key to success of many of these products.
And
What
when
is
you
a
can
bank?
build customer acquisition into the product design.
You guys have been talking about this and you described movement of funds, payments. What is a bank? Is that all it does?
The whole interesting.
Because moving funds around is clearly going to end up being a pure commodity, automated business.
For sure.
Banks do 3 things, okay? I'm oversimplifying it. There is mechanical things, movement of funds, safe custody. There's asset and liabilities. World wars, whatever, were funded by people taking and balancing people who had excess funds with people who needed funds. And then there's risk. We've talked about payments, and you talk about banks and mitigating the banks, but you haven't talked about the two things that banks do that really matter, which is take long-term relationship, risk-based analysis of assets and liabilities and risk. If we're just talking about payments, then let's talk about payments, which is a commodity activity, and you're in a race to the bottom to automate something that needs to be streamlined, absolutely, and risk mitigated. But when you talk about all this analysis and insights, there's one thing to risk management of a commodity activity, and there's something to using that analytics to doing asset and liability management and risk management, which is what banking is.
Yeah, that's where the money comes from.
That's where the money is
coming
made. And okay, automate and streamline payments. Engineer it away, and it needs to happen, and that's great, and people will make money doing that. But don't talk about banking unless you're going to address asset and liability management and risk and credit and all of that sophisticated long-term relationship analysis. If you're going to engineer that away, that's cool. But if you're just talking about payments, talk about
I
payments.
think
Don't
that
talk
the
about
payments
banking.
is like, the first wave of the fintech. I think that's, a lot of lessons or examples have been taken because those are some of the larger companies now that have all that consumer base that are rebundling. I think maybe that's where some of the
And all the
payments
fintechs have a
focus
pay. Every single one, every example that's been mentioned tonight about.
That's the stick on the pig then. So they're front-ending the bank. Are they banking, or are they relying on a bank
Relying
to do their work?
But if you look at what happened in Germany with N26, they started on Wirecard, but then they got their own charter, and now they're all over Europe. They're about to enter the US market. They have well over 1 million customers. They were enrolling more customers per month than the top 4 banks here in the US. So like,
I was actually just saying about Revolut.
Revolut,
My company's
that's
on L39 in London, and Revolut's on our floor. They have 150 people total that work for Revolut in a level 39 type environment. They don't even have their own offices, and they have 5 million customers. And all the guys who work for my company use Revolut, and you go travel with them, and they're like, look at this, it's so cool. They're bragging about their bank. And when was the last time somebody did that?
We do that with Chase, right?
We brag about
Well,
Wells.
auto catches faster.
No, but sorry for being naive, but what do they do that's so cool
Oh,
that,
they were
I'm just
I mean,
saying,
we
at a
were
high
sitting
level.
in Brazil, and he charged on his credit card, and he sat there with his Revolut phone, and literally before the guy practically left the table with his credit card, it was on his Revolut phone as a charge
He
there.
changed it to Brazilian Real.
But I mean, the whole thing, I mean, this is it. These guys are just bragging about it. And when you go to L39 in London, they're like, that's Revolut. 150 people. And yeah, maybe they have the backbone of some other bank, but they've created this whole customer
It's actually a
interface.
bunch of banks.
So yeah,
Yeah,
so they
it
create
probably
they
is.
use enterprise infrastructure.
Yeah.
They use us for currency
cross-currency.
But then eventually, when they get to a certain scale,
They
does it
bundle
make
a whole
sense
bunch
to
of
buy a
packages
bank?
together.
Yeah.
Well, I mean,
You
eventually
get your
they'll
own
be
charter.
outside of the US.
If they're program
banking
entities,
license.
program
Yeah.
entities,
Stripe
funds,
as merchant funds.
They do.
Yeah.
They market.
And customer service.
Vara Money is doing the same thing here.
In one of our last night
There's another
events, somebody
charter.
said something to the effect of the only saving grace for retail banks in the future will be commercial lending. Period. Because everybody else is just chomping and will just take up everything else. Do you guys agree with that statement?
It's been wrong.
Yeah.
Well, right now, look at the successes of the banks that are growing and getting larger. It's on the commercial side. It's, just in the New York City marketplace. You got Sterling National Bank. They used to be this little rinky-dink, $1 billion in asset. Provident Bank, now they're in excess of 10 billion, and who knows how big they're going to get. It's on the backs of commercial lending. Yes, they've brought in and purchased some other consumer accounts, but it's on the back of commercial lending. And you see that across the board. Umpqua on the West Coast. Everybody thinks it's because they have full branches. The reality is they were one of the early community banks that adopted this commercial banking strategy, and that was last century. And so to that point, yeah, I totally agree with
I think
you.
it's his point too about like it's debits and credits about like.
Enterprise. We got a question. We got a question back here from Jeff.
I
I
just
think
want to
yes.
just defend, because I don't want to be, I'm not defending the incumbents. I'm saying if you want to do your innovation and disruption and all that good stuff, it's one thing to re-engineer payments. Now re-engineer asset and liability and risk management, and then you're really in play.
Yeah.
But as long as you're front-ending banks, all you're going to do is streamline what is going to be a commodity
I
business.
want to kind of comment from this gentleman back here.
I just wanted to like see if we could like maybe go past just payments and banking. I mean, I think fintechs have been touching in disruption in the financial industry in many different aspects, such as wealth management, crypto, 401ks, Betterment, I think was a great example. And I just wanted to, my idea is that the alternatives and the different spaces and the different verticals that are being explored are going to be continuing to shifting away from the big banks. I was a Merrill Lynch customer for many years, a Morgan Stanley customer for many years. I wasn't the guy that is like, paying for, the furniture. I was one of their clients. So I was always put in a cookie cutter portfolio, and I never got the returns that I wanted to get from my portfolio. So I started looking for other alternatives, and that's how I found the smaller players, and that's how I found, digital players, because I'm younger. I'd rather use my computer to find the alternatives that I want to invest in. So I wanted to see if you guys have something to say about how fintech continues to evolve. And okay, we started with 401k, we started with banking, but now we're like going into a space that we're like, finding these small niche places where we're like catering to like people that want to invest in art, people that want to invest in collectibles, hedge funds, you name it, alternatives, so metals or other things. And I think the fintech is growing in all those different spaces, and the competition is growing on that. Payments and banking is big, yes, but how about all these other verticals that we can explore?
I think it's happening. I think payments was the first one, and maybe that's why we latched onto it and started talking about it. But you're right, it's happening across the board in all these different little niche verticals within the finance industry. And it's fascinating to see what's being developed and what's coming out of those. And I think some of them are consumer focused, some of them are enterprise focused, but it is happening, and that you will get some really great big players within those side things as well.
I think the same model is being followed across each product. So it's cut out the brokers, create a transparent product, make the entire thing digital, which cuts out more people, and it's a lot cheaper. So, Morgan Stanley's top rate they could charge on a wrap account, which is no better than what a robo-advisor is going to give you, is 3%, the range of 1% to 3%. On Wealthfront, you're paying 25 basis points. I think if you go over, and in each one of those cases, there's a back-end provider to it. If you go over to insurance, there's a company that I invested in that is direct-to-consumer term life. So they don't offer universal life, they don't offer whole life, annuities, just term life. And you transact immediately. And they have Hanover rate on the back end that says, if you can find many customers that look like this, we'll give you an instant policy. I think over time, it's all that, once companies reach scale, then they're going to start thinking about ways they can go further back into the stack to capture some of those economics. And I don't think I think it could be buying a reinsurer. I think it could be buying, a merchant acquiring bank and, just going back as far as they can. But that's not going to be possible until they, they're growing on the front end. So it's kind of the model I'm seeing across everything.
I know I'm ready for another beer, but carry on talking, please. You can see the conversations we always get at
We're up
NYPAY.
till 9 o'clock. They're gonna come in.
They kick us out. Okay, what time is it? So you got till 9 o'clock to carry on talking and finish on the beverage. Guys, like I said earlier, please make sure to respond when we get this note, probably in mid-November. We do this 10 times a year or so, and always try to get a good conversation going, as you saw tonight. And I thank you very much for attending. Thank you. Thank you to the panelists.